Hi guys, we're just going to do a little bit of revision here for the type of calculate questions that you could face in the paper one. So let's get stuck into this. Now, next slide looks a little bit heavy. It's got all of the different formula you need for this paper all on one slide here. Okay, so you probably want to pause this, have a little look through it, and just process what we've got here. Okay, so there's that key information there. Okay, now it's well worth you then just pausing the next screen and just having a go at testing yourself to see how well you can actually remember all of these different calculations. All right, so ultimately this is everything you need to know there. Okay, so for break even, for profits, for interest in percentage, margin of safety, cash flow there. Okay, we got the lot here all on one slide. All right, so you can have a go at rewriting those, just see how well you actually get on. You can pause this screen, give it a run through. All right, nice one. So let's put them back in. It's well worth practicing that again and again. So let's now have a little look at some various different questions we may well find here. So let's add in those questions now. Right, okay, so calculate the total cost of the business here. Okay, so again, you can pause this, you can give this a go, and then we'll run through the answer. All right, so what we can see is firstly the fixed costs are £1,200. Okay, so we got £1,200, but we can also see that there's an individual variable cost of 45p. Now it's no good just saying 1,245p because you've got 300 of these 45p's, of course. All right, now these are all 2-mark questions, the calculate questions, so therefore you want to be multiplying the variable cost by the quantity to get your total variable cost. And when you multiply through, what do you get? Well, you get £135 of variable cost. Okay, so in this example we can see that the actual total cost faced by the business is going to be £1,335. all right, so 300 times 45p added onto our fixed costs. Lovely job. All right, now what do we got next? Well, we've got calculated total costs during the month. Okay, calculated total revenue during the month. All right, so here we can see we've got 200 of these plates. This is the price and this is the cost. Now be clear on your actual terminology in the exam and make sure when you're talking about what the business has paid for something, you're talking about cost. What the consumer pays though is the price. All right, so that's an important point to be aware of. So here we can see that you're going to have to do 200 times not £12 to calculate our total cost, but 200 times 3. And when you go 200 times 3, of course, you're going to get 600. So this 200 multiplied by the 3 gives you a total variable cost of 600. Add that to your fixed costs and you end up with 1,200. all right, so calculate the total revenue. Well, this is where of course we've got to use price times quantity sold. All right, so the price is 12. Okay, and we can see that we've actually got what 12 plates that were actually sold. Okay, so when you run through that, what do you get from 200 times 12? Well, you get 2,400. all right, lovely job. Okay, explain one reason why a business owner might want to reduce the variable cost per unit. Okay, well, this is going to increase their gross margin. This is going to increase their unit contribution. It's going to mean that they've got a greater contribution to covering their fixed costs and giving them profit. All right, so IDLT there. Lovely. All right, so let's have a little look at completing this little table that we've got here. Okay, because the information could be presented like this. So we've got 3,000 total revenue, we've got fixed costs, we've got variable costs, we've got total cost. Okay, so here the profit or loss, 3,000 minus 2,800 equals 200. all right, nice and straightforward there. Now this one's a different interpretation, of course. Okay, so we can see fixed costs are 600 still. Okay, we're unsure as to what the actual variable costs are. Now, what we can see though is that we're missing our variable cost and we're missing our total cost. All right. So how are we going to get this missing information? Where's that information going to come from? Well, the first thing is if you subtract from 3,000. Whoop! I've jumped ahead. Sorry. So if you subtract fixed cost £600 there. From your 3,200, that works nicely. That gives you 2,600. We've got to subtract, however, this £500 profit, and basically the difference there, the remaining amount from that is going to be £2,100. So your missing amount here is going to be £2,100, and your total cost is going to be £2,700. All right, because ultimately 500 is the difference there. All right. Okay, so that works pretty nicely. I mean, the easiest way of actually doing this is to go total revenue minus this, and that tells you what the missing amount is going to be. In terms of the total cost, and then you just need to subtract the fixed cost from the total. All right, good. What do we got next? So using the information in table 1, calculate the profit for this business. You're advised to show your workings. So in this scenario, we can see that they've got fixed cost 2,100, variable cost 110, and a sales price per unit of 200. Okay, all right, now it also tells us that they've sold 270 units. Now, the easiest way to actually work out the profit in such a scenario is to take your price and subtract the variable cost. This gives you your unit contribution. Okay, that's £90. So 200 minus 110 is £90. If you then multiply that by the number sold, you can see that 90 multiplied through by 270 is going to give you 24,300. But we're not done yet because we haven't got rid of this fixed cost. So then we need to take away that fixed cost, and when we take away that fixed cost, we're left with what, 22,200. All right, I hope that makes sense there. Okay, that's a nice quick way of actually calculating profit. Do try these questions again if they don't make sense first time. All right, so next one, what do we got here? Calculate the percentage increase in revenue between January and March. So we can see January is 5,000, this one's 7,000 in March. So here you've just got to work out a percentage change. How do you work out percentage change? Well, it's just change divided by original times 100. All right, it's change divided by original times 100. So you can see the change is 2,000. Okay, so it's jumped up 2,000. The original was 5,000. All right, so when you actually put that through, 2,000 divided by 5,000, and then you multiply the answer by 100, you get 40% change. Okay, so that's a decent increase in revenue there. All right, next one. So what do we got here? Okay, identify the total number of sales that Neil and Sue will need to break even. So we've got our total cost line, we've got our total revenue line here. Okay, just make sure you follow the key carefully. You can see our fixed costs here, we can see our variable costs here. Okay, so our break-even point is here. Okay, and we can see that that is going to break even at what, 200 units. All right, so they need 200 units or 200 sales there. All right, so identify the profit made by Meringue by shading the correct region of the graph. Okay, so identify the profit. Now, yeah, we can see that this area here is going to be our profit area. Okay, so all you've got to do is shade the area where total revenue is greater than total cost, and that's this bit here. This is the area of loss. Total cost is greater than total revenue here. All right, so hopefully that makes sense there. State one benefit to Meringue of having a low break-even level of output. Well, that means that they only need a relatively low number of customers, okay, over the period to actually break even, okay, so that's pretty good. All right, which one of the following is a benefit of starting a business, a franchise? Okay, right, fine, support from the franchise, all that makes sense. Anyway, okay, so we can see that this business is going to make 400 units of output, okay, 400 units of output. Calculate the margin of safety. So we're up here. We can see that the break-even point is here, where total revenue equals total cost. So therefore, we can see the difference, 250 to 400. Actual output minus the break-even point is 150. All right, lovely job. Okay, the table below shows the cash flow forecast for a small business. Again, pause these as we go through them, all right? Have a go at them rather than just listening to me explain them. Okay, you'll get so much more from this, actually testing yourself. Okay, so what we can see here is that money out is totaling 10,170. Money in, or receipts, is 17,400. All right. So all we've therefore got to do, and make sure you take a calculator into the exams. Really important. Okay. So many students just forget to do so, and it's well, there's no excuse for it really. Anyway, what do we end up with here? 7,230. Okay, that's our net cash flow because receipts minus this. There we go. Right, next one, we've got to work out our total payments. We can see we've got to add up these raw materials and add up the fixed costs there. That will give us our total payments figure. Okay, so go and get that done. Nice one. Right, calculating cash flow. What about this? What do we got here? So we've got cash inflow, we've got cash outflow. This is our receipts, this is our payments, all right? So cash inflow is receipts, cash outflow is payments. This has gone down. Well, you know, you can see that the payments are greater than the receipts to a total of 4,000. So that's a net cash flow of minus 4,000, because net cash flows, we just saw in the previous example, is receipts minus payments. So as such, you can see that there is a slight issue here. All right, now to calculate the closing balance, all you've got to do is you've got to add you've got to subtract that 4,000 from the opening balance. Okay, if it was the other way around and cash inflow was greater than the cash outflow, then you'd add that on and it'd be what, 22,000. But as you're taking it away because it's negative, of course it's going to be 14,000. all right, super stuff. We've got another one we can practice right here as well. So here we can see that cash inflow or receipts is 12,000, cash outflow 19,000. So that is negative 7,000. Okay, what's going on here? Well, look, we don't have the actual receipts or cash inflow figure here. But we can see net cash flow is minus 8,000. So this tells us that this one is £8,000 greater than the money coming in. Okay, so it's 8,000 greater than the money coming in. Just as we saw this was minus 7,000 here, it's £7,000 greater. So this one is, of course, going to be what, 14,000 up here. All right, so yeah, that makes sense. Now, finally, we can see that we've just noticed the way these closing balance go through as well to become the following month's opening balance. That's important to be aware of. We got minus 16,000 here. We had an opening balance of 5,000. So what's happened next? Well, we've got minus 11,000. Okay, not so good. All right. Okay. A retailer selling frog bikes has the following financial information for the month of April. Okay, using the information, calculates 2 decimal places the value of total payments as a percentage. All right, so the value of total payments as a percentage of receipts. So all we've got to do there is 700. So we've got to take that 700 and then divide it by the receipts value. Okay, so 700 divided by the receipts value gives us 58.33%. All right, notice it says 2 decimal places, so make sure you put them in, make sure you put your answers down here. Okay, fine. Calculate net cash flow for April. All right, so can you now calculate that net cash flow? Well, we can see we've got money coming in here, and we've got money going out here. Okay, so the net cash flow is what, 500 in this instance. This is due in 60 days, so that's not going to be received in April. All right, that's there to kind of throw you. All right, so just be aware of that. All right, next one. What do we got next? Table 1 contains information about the number of new business startups. All right, so using the table calculates 2 decimal places the number of new startups in Birmingham as a percentage of the number of new startups in London. All right, so we've got Birmingham here. Okay, we've got London here. All we've got to do, very similar to the last one we just looked at, 17,473, which is our Birmingham total, divided by 205,320 equals, and then of course you've got to multiply it through by 100 to get the full percentage. You can see it's going to be what, 8.51% there. Okay, all right, so put the answer in down at the bottom. Explain one impact on a small business: reduction in government taxation. Okay, all right, so that may mean that less income tax is payable. That may mean that consumers have more money to spend. That may mean that sales may rise. Okay, so could be something along those lines. All right, that would work nicely. Okay, so what about this one then? Calculate the interest. Borrowed amounts 5,000. The repayment per month is 158.18. Okay, and the duration is 3 years. All right, so what's going on there? Okay, so what you've got to do, you've got to take this to work out the total amount. Now this is tricky, to be honest. I wouldn't expect them to include something quite as hard as this, okay, because then you've got to multiply it by 36 months over which time you're actually paying this. So this means that you're actually, when you do that, 158.18 multiplied by 36, 5694. Okay, so 5694 put into that borrowed amount. Okay, so then we subtract that 5,000, and then we divide it by 5,000, which is the total amount. Okay, and we times through by 100. Okay, we get 13.88%. Okay, so that's the way that one breaks down. All right, lovely. Okay, so next one that we've got here is over 4 years. So this is again a tricky one. Okay, again, like I think they're likely to give you the total amount paid. Okay, so they are likely to do that just to make things a little bit more manageable for you. So we've got £116.50. Multiply that through by 48. Okay, we've got a £5,000 loan. Okay, so and we can subtract that £5,000 and then we divide by 5,000. Okay, well, what do we get? We get what, 11.84%. Okay, right, great stuff, guys. We'll leave that there. I hope that's been useful. Thank you very much.